Have you ever glanced at your credit card statement and felt a shiver down your spine? It's a common reaction, especially when you see those daunting numbers staring back at you. The high balances and the interest rates can be overwhelming. Those double-digit interest rates can be terrifying. They seem to climb higher and higher, making it feel almost impossible to pay off your debt. But why are these rates so steep in the first place? But have you stopped to wonder why they're so high? It's not just a random number picked out of thin air. There's a method to the madness, and understanding it can help you navigate your financial journey more effectively. The answer, like most things in finance, is a mix of factors. Credit card companies have to account for the risk of lending money to consumers who might not pay it back. They also have to cover their operating costs, which include everything from customer service to fraud prevention. It boils down to risk, operating costs, and yes, even profit for the credit card companies. They need to make a profit to stay in business, and that profit margin is built into the interest rates they charge. Understanding these factors is the first step to taking control of your finances and avoiding the credit card debt trap. By being aware of why rates are high, you can make more informed decisions about how to manage your credit and minimize your debt. Knowledge is power, and in this case, it can save you a lot of money in the long run. Credit cards offer convenience. They are a popular financial tool that many people use daily. They let us buy now and pay later, making it easier to manage our finances in the short term. But this convenience comes at a price: interest. Interest is the fee you pay for borrowing money. When you use a credit card, you're essentially borrowing money from the credit card company. This isn't free money. It's a loan that you have to pay back, often with a hefty interest rate attached. The interest rate can vary depending on your credit score and the terms of your card. This interest rate is how credit card companies make money. They charge you for the privilege of using their money. It's the cost of borrowing, and it can quickly add up, especially if you're only making minimum payments. Over time, these interest charges can accumulate, leading to significant debt. Understanding the terms and conditions of your credit card is crucial. Always read the fine print to know what you're getting into. To avoid high interest charges, try to pay off your balance in full each month. Setting up automatic payments can help you stay on track. By managing your credit card wisely, you can enjoy its benefits without falling into the trap of high interest debt. Credit card companies charge high interest rates for a simple reason: risk. When you apply for a credit card, the company assesses the likelihood that you will repay the borrowed amount. This process involves evaluating your credit history, income, and other financial factors. They're lending you money they haven't verified you can repay. Unlike secured loans such as mortgages or car loans, credit cards are unsecured. This means there's no asset backing the loan, making it riskier for the lender. Unlike a mortgage or car loan, credit cards aren't backed by collateral. If you fail to make your payments, the lender can't seize your home or car to recover the debt. If you default on your credit card payments, the lender has little recourse to recover their money. They may resort to debt collection agencies, but this process is often costly and time-consuming. To compensate for this risk, they charge higher interest rates. These rates help cover potential losses from defaults and ensure the lender remains profitable. The higher the perceived risk of lending to you, the higher your interest rate will be. Factors such as a low credit score, high debt-to-income ratio, or unstable employment can all contribute to higher interest rates. By understanding these factors, you can take steps to improve your credit worthiness and potentially secure lower rates in the future. High interest rates aren't just about profit. Credit card companies have operational costs too. They have to process transactions, maintain customer service departments, and cover losses from fraudulent activity. These costs are factored into the interest rates they charge. Additionally, marketing and promotional expenses, like those generous reward programs, all contribute to the overall cost of offering credit. High credit card interest rates can trap consumers in a cycle of debt. When interest rates are high, it becomes harder to pay down the principal balance. Minimum payments often only cover the interest, leaving the debt to grow. This can lead to a snowball effect, where debt accumulates faster than you can pay it off. The result? Financial stress, damaged credit scores, and difficulty achieving financial goals. Understanding how credit card interest rates work is crucial for healthy financial management. Financial literacy empowers you to make informed decisions about credit. Always pay your credit card balance in full each month to avoid interest charges. If you must carry a balance, prioritize paying it down as quickly as possible. Remember, credit cards are tools. Used responsibly, they can offer convenience and rewards. Used unwisely, they can lead to a mountain of debt.